Today on the Apartment Dealer Show, we're talking all things multifamily, the second quarter of 2023. It's in the books. Where are we in terms of property values, cap rates, interest rates, and we have a surprise guest to give us details on where the market is headed. Stay tuned. Hi, this is Chris German, and welcome back to the Apartment Dealer Show. Today we're doing our market update video for the second quarter 2023. Where are values trending? Where do we see cap rates? Where do we see the market headed? And as I mentioned, we have a special guest to dive into all things interest rates because that is having the biggest impact on our market today. Now, as we have in the past, we chunk down this information by what we call corridors. And those corridors, we group together certain cities based upon the tenant profiles, the rental rates, and the property values. We have the East Los Angeles corridor, which consists of Boyle Heights, East LA, El Sereno, the 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Paramount, Southgate, West San Gabriel Valley, Rosemead, San Gabriel, Temple City, East San Gabriel Valley, Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina, the 605 corridor, Bellflower, Downey, La Habra, La Mirada, La Puente, Lakewood, Montebello, Norwalk, Paramount, Pico Rivera, Whittier, Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland, and Inland Empire East, Bloomington, Colton, Fontana, and Rialto. Now, for each of the corridors, we're going to be covering how many sales took place in the second quarter. What was the total sales volume? What is the average price per unit that we saw in the second quarter? What is the average cap rate of today? What is the average GRM, average price per square foot? What was the highest sale in each particular corridor, meaning those outlier sales, those unicorn sales that we see sometimes, as well as, well, let's take a look at what's happening currently with where we were this time last year, because it is a huge difference. And then we're going to discuss, of course, well, what's having this such a significant impact on the market. So let's dig in. East Los Angeles. So for the second quarter of 2023, we've had 4 sales so far for a total sales volume of $6,095,000. The average price per unit in the area is $202,875. The average cap rate is 6.2%. The average GRM, 13.37. The average price per square foot, $340. And now, when you take a look at, well, where we are end of second quarter 2023 versus where we were at the end of quarter 2 2022, well, let's take a look at the cap rate because that's an indicator of value. Last year, this time in this corridor, the average cap rate was 4.54%. Here we are at 6.2%. That's a huge increase in cap rates. Well, what does that tell you? That tells you prices have gone down. Now, if you look at sales volume, this time last year, there was 13 sales total for the first 6 months of 2022. So far this year, we've had 8 sales. So total sales volume is down. The market has slowed, and along with that slowing, property values have declined. Now, in terms of our outlier sale or highest sale of quarter 2 was this 5-unit in the city of El Sereno, sold for $1,670,000, which amounted to $334,000 per unit. So again, when the average price per unit is $202,000, this one sells for $334,000. That's why I say this was one of those outlier type sales. The 710-91 corridor. In the second quarter, we had 9 sales for a total sales volume of $13,484,272. The average price per unit today is $236,434. The average cap rate is 4.68%. The average GRM, 15.84. The average price per square foot, $342. Now, where were we this time last year? Well, let's take a look at cap rates. Cap rates were at 4.38%. 3%. Those have now increased to 4.68%, meaning property values have declined. Not as much as the previous corridor, but nonetheless, they have declined. Total sales, and this is very telling. This time last year, 27 multifamily properties had sold. Where are we at a total for 2023? 12. Less than half the amount of sales in this particular corridor that was very active last year. So it begs the question, we're 2 corridors in, why are we seeing the decrease in values and the decrease in sales volume? We're going to get there. The outlier sale for this particular corridor was the 6-unit in Southgate, sold for $1,769,000, which is $294,000, almost $295,000 per unit. So when you're talking about the average of $236,000 versus $294,000, that's a much higher price. This particular property definitely showed pride of ownership. A lot of renovations had been done. And so that always goes to the point that we share with you that quality does matter. Of course, in the end, the rental rates that your property is collecting and the condition that it's in, of course, will have an impact on the final sales value. The West San Gabriel Valley for our second quarter here has had a total of 3 sales for a total sales volume of $8,842,000. The average price per unit, $339,317. The average cap rate was actually not reported for any of these 3 sales. But to give you some flavor of where we were last year this time, we were at about a 3% cap rate. In general, if with the data not being provided, you would say, well, Chris, take your best stab at it. I would say might have to be much closer to 4% because of some other information that we're going to be sharing. 4% cap rate, that is. The average GRM for these sales, 23.52. The average price per foot, $395. And when you look at the total sales volume for this year thus far, there's been 6 sales versus this time last year, there was a total of 4. So this is one of the rarities that we're seeing here lately. Actually, there's been more sales in a particular area versus last year. For our outlier sale in the Western San Gabriel Valley, we have this 8-unit in the city of Temple City, was a newer constructed property. 8 units sells for $3,750,000, which equates to $468,750 per unit. And that's a hefty price for the area. The East San Gabriel Valley. Quarter 2, we've had a total of 8 sales. Those 8 sales have amounted to $25,175,000. The average price per unit, $265,000. Our cap rate for quarter 2, 4.52%. The average GRM, 13.74. The average price per square foot, $365. Now, what was our cap rate this time last year? 3.87%. We were below a 4 cap this time last year, and now we're at a 4.5 cap. What does that mean? Again, that means property values are down. Total sales. When you take a look at where we were this time last year, 21 multifamily properties had sold in this particular geographic corridor. Today, 10 sales for the first 6 months of the year. So about half the number of buildings have sold this year when compared to last year. For our outlier sale, we have this 8-unit in the city of Azusa. 8 units sold for $2,450,000. That was $306,000 per unit. And this was a newer constructed property. This property actually was on the market previously, went expired, then was sold off market. I would argue had this property been on the open market, actually would have traded for a higher price per unit. That's my opinion, but just to give you some background on this particular property. The 605 corridor. In quarter 2 of this year, we've had a total of 5 sales amounting to $23,940,000, which equates to $244,533 per unit. The current cap rate, not enough data was available for all 5 units to give us an average, but where were we last year? In the 605 corridor, we were at about a 4.1% cap rate. Looking at it today, I would say we are much closer to a 5% cap rate in this particular corridor to get a property sold. The average GRM, 15.22, average price per square foot, $334. And when you look at total sales, this is very telling in this particular corridor, very telling of the market and what shape we're in right now. This time last year, 41 multifamily properties had sold. Where are we at today? 17 total sales, less than half, significantly less than half. So not as much sales volume, and again, prices have gone down. The one outlier sale that we'll share here in the 605 corridor, this 28 unit that sold in the city of Norwalk sold for $7.3 million. That equates to $260,000 per unit. And again, when we're looking at an average of $244,000, that outlier wasn't all that much more at $260,000 per unit, but nonetheless was the highest sale in quarter two. Inland Empire West. For quarter two, we've had 3 sales. Total sales volume, $4,465,000. The average price per unit, $182,000. The average cap rate, 5.48%. The average GRM, 13.57. The average price per square foot, $428. Now, our cap rate this time last year was actually 3.8%. Here we are now at about a 5.5% cap rate. That's a significant swing in cap rate, meaning a significant swing in value. And total sales, again, another corridor where we're about half of where we were last year. This time last year, 20 multifamily properties had sold in the Inland Empire West. As of today, 11 buildings have sold, or 11 multifamily properties have sold in 2023. In terms of outlier sale, my team and I sold this 5-unit property here in the city of Pomona. This sold for $1,185,000. That equated to $237,000 per unit. So when you look at the average per unit in this corridor, in this quarter, which was $182,000, this building sells at $237,000. You say, well, Chris, you sold this property. Tell us more. Why the difference? One of the main differentiators here is that this seller, the individual who sold this property, actually provided private seller financing. So if you're not familiar with private seller financing, we have videos that explain that on this channel. But essentially, the seller acted as the bank, carrying back a note, which was interest-only payments. And so that's very advantageous for a buyer. There's less loan costs, no lender fees, origination fees, doc fees, appraisal fees. So it's cheaper in terms of obtaining a loan. You have the interest-only option. So again, many investors look at multifamily that it's about extricating as much cash flow as you can, not necessarily paying down principal. You let the building appreciate and go up in value, but you want to extricate as much cash flow as you can to set that money aside to then go buy another property. So they're not concerned about paying down the principal. So they find an interest-only loan very advantageous for their strategy. That lends to more buyers with interest. And because you're not going through the full loan process, and as I mentioned, less cost, there's always more buyers for a property. When the seller is offering private seller financing, that had a big impact on the final value of this particular property. And finally, the Inland Empire East. For quarter two, we've had 2 total sales. Total sales volume, $9,850,000 with an average price per unit of $202,000 per unit. Our cap rate is 4.3%. GRM, not enough data was available for the sales comps, but our average price per square foot, $268 per foot. This time last year, properties were selling at a 4.1% cap rate. Here we are today at 4.3%. So not a huge differential. So property values have adjusted slightly, but not a whole bunch. But sales volume. This time last year, 9 multifamily properties had sold. We have a total of 3 sales thus far this year. So you're talking about 1/3 of the sales volume. Now, the highest sale in the Inland Empire East was this 12 unit in the city of Fontana, sold for $3,050,000. That equates to $254,000 per unit. So that was a high price given the average in the area. So now you may ask, what's happened to the market? Because COVID and all that COVID brought, is gone. Eviction moratoriums are gone. Yes, vacancies are taking a little bit longer to fill. If you watch my last video, and we'll put a link here on all things rental rates, you know that vacancies are taking a little bit longer to fill. But nonetheless, it's not like landlords are having to give tenant concessions, 3 months rent, and this sort of thing. And the rental rates are still historically high. So what could have such an impact on the market? Because again, if the clientele is there, tenants, full buildings, and the income, rental rates is still there, well, those are two of the main influencers of value. Why such a depressed market? Or maybe not depressed, but why such a change in the winds? Why are we talking about in general that we're doing half or seeing half the sales in total in all these corridors, about half the sales that we saw last year? It boils down to interest rates. So what's plaguing the market and has everything to do with interest rates, how interest rates have impacted cash flow, and how that has changed the sentiment of investors. So let's take a look at this, because I want you to understand how it really boils down to the interest rates. The interest rates have had the biggest impact on the market. But you say, well, Chris, the interest rates haven't gone up all that much. Well, have you got a loan quote of late? We're going to be bringing in Gabriel Figueroa here in a second to go through current rates. You'd be shocked at how high rates are currently if you're looking for a new loan. But let's take some basic numbers here. So let's say you had $1 million property, okay, and you're putting 40% down, $400,000. That property collects $72,000 gross income, and let's say the expenses are about $30,000, leaving you in net income of $42,000, giving you a cap rate of 4.2. That was about the average cap rate, if you will, say beginning of last year, maybe end of 2021. Well, interest rates say we're 4.25%. So at that point, your cash flow was $5,519. Well, now let's flash forward to 6%. You take that $1 million property, same tenants, same income, same expenses. All we've changed is the interest rate on the mortgage. Instead of now having a positive cash flow of $5,519, you're actually negative $1,168. We've only increased the interest rate 1.5%, and our cash flow has changed by 121%. So what does that mean in terms of value of the property then? That answers the question of cash flow. Okay, so buyers are not excited to see their cash flow dwindle, especially when you're talking about now individual cities are coming up with their own versions of rent control. You go to the courthouse. It wasn't friendly before. It's even that less friendlier now. So in other words, there's more risk involved. Investors, apartment investors, landlords are looking for cash flow. If not for the cash flow, why take on the headaches and the burden? So they're saying, okay, in this scenario, let's take that $1 million building, and I'm going to take a look at the investor speaking, the buyer. My rate of return, my cash flow would have been $5,519 when the interest rate was 4.5%. I still want that same cash flow today for my time, my risk, my energy involved, and all the rest. Well, in order for me as the buyer to still collect $5,519, instead of me paying you, Mr. Seller, the price of $1 million, unfortunately, given the dynamics of the lending market right now, I can only afford to pay you $878,000. That's a change in price of $121,000. So that is what's having the greatest impact on the market today. It simply is the increase in interest rates and all that has meant to the banking system. Less lenders doing multifamily loans. The requirements becoming more stringent. Underwriting has changed. So to address these concerns of, okay, well, the commercial lending market has turned the apartment market topsy-turvy. Where are we headed from here? What has changed? What's the dynamic when one's looking at a commercial loan to purchase a multifamily property? By chance, we were able to bring in Gabriel Figueroa, who was here to meet with me, to meet with a client that we're working with to help purchase a building. And I said, hey, why don't you step in for a few seconds? let's talk about interest rates because, again, this is what's plaguing the market. Now, let's go to Gil's comments. So I thought, given everything that I've said thus far about the market, interest rates and what have you, why not bring in the man himself, Mr. Gil Figueroa, the commercial lender that I turn to most often, to explain to us what in the world is going on with interest rates, what's going on with the lenders, because that's having the greatest impact in our marketplace today. So Gil, thank you for being with us. And
thanks for having me.
We're going to talk all things loans.
Awesome.
So Gil, I'm going through right now our market update video, Q2 2023. And a lot of the woes we're feeling in the market, if you will, is all due to interest rates.
Right.
Rental rates are still high. Buildings are still essentially full. It's taking a little bit longer to fill vacancies. But nonetheless, buildings are full. It's not like we're seeing people offer concessions right now, a month free rent. We're not seeing that, at least in the corridors that we work. So why then? Why are we experiencing what we are in the market? It's the increase in the rates and what that has done to essentially buyer optimism, skepticism, if you will, right? And not just, and that it's not even emotion. It's hey, the higher rates have cut into cash flow.
Right.
So maybe let's start there. I know we've discussed this before, but say roughly for every 1% that interest rates go up, how does that impact the buyer or and the value of a property? Say,
well, it drops the loan amount by 12%.
Wow.
For every 1%. Yeah. And last year, we started with treasuries in the twos, and we hit a marker in I believe it was August of last year, where we're at 252. And I warned you and all my agents that we're headed to 4%. And that was in August. So by the October, from August to October, we went from 2.5 on the treasuries to 4.3. That's a drastic change. And since then, we've been hovering between 3.5 and 4% the whole year. Mm-hmm. Just recently, the last week, we went from 3.7 to 4% again on the treasuries. And banks now are very aggressive on pricing as far as bumping the rates up.
Yeah, so, not aggressive in a good way.
Not aggressive in a good way.
Yeah. Aggressive in the old days would have meant more leverage and what have you.
Yeah, that's not happening. Mm-hmm. And but our product line, the good news is banks are really motivated to lend on multifamily and industrial. Those are really the only class that they're interested in right now. So they've let go of office. Even mixed use is starting to get a little more difficult to finance. But office is definitely off the table for, I'd say, 9 out of 10 banks.
So they'll finance multifamily. They're happy to finance multifamily,
right?
But you as a buyer may not be excited in terms of the rate. And that's really when the market third quarter of last year, the market did an about face to the point where in a lot of the corridors that we work, we're doing, or the market has sold about 50% of the inventory that we would have, or in comparisons to this time last year. That's a huge difference. So It's not like the market is shifting. And so, okay, it's a gradual shift. And so we're down a little bit this year, going to be down a little bit next year. No, we got chopped in half.
Yes.
In terms of, are you experiencing that with the other agents that you work with, that they're singing the, crying the blues too, that the market is a bit much?
Yeah, I'd love to say no, but I am. And we're seeing it across the board. We're seeing it for all, and I deal with, top guys just like you, Chris. So, all across the board, they're feeling it. I think some of the markets where the real estate has done really bad, the agents have had an opportunity to sell, like some of LA. So they've been busier. Some of LA or Long Beach has been a little busier, but where the properties have stayed kind of stable and still, decent neighborhoods and good neighborhoods, we haven't seen much movement. So, the owners have a great rate. They probably don't want to do anything and disturb that, so to speak. And maybe they don't want to see the reality of today's market based on, cap rate versus interest rate.
Right.
So it has changed drastically. So there is a change.
Well, sure. And
yep.
So I want to get to, because that is a bubble that's expanding in terms of those people that got a good rate 4 or 5 years ago. And now they're coming adjustable, and they're going to go adjustable soon. So I want to touch on that. But
sure.
Before we go there, let's talk about just lending in general, the requirements. So number one, are we talking about more banks, less banks? And then number two, versus this summer of last year, underwriting, buyer qualifications, what's changed in the world of lending the last 12 months?
Well, a lot of lenders they've increased their rates for one, and they're not lowering debt service requirements. They're still at 120 or 125, depending on the lender. That has not changed. They're looking for solid people who have a track record. So if you're first to the market now, you're not going to be, you're not going to get the A pricing, so to speak. They are looking for some experience. So they're looking for that kind of operator. And the local banks, a portfolio, as you know, we've kind of lost a couple of good banks that are no longer lending. But with that being said, we're doing a lot of agency loans with Fannie and Freddie, and they've just as aggressive as always. Nothing's really changed for them. Pricing seems to be a little better too, as far as pricing market is concerned.
So July 2023, what's the average rate for, say, $1 million loan, multifamily on a 1960s building?
Yeah, based on treasuries today, the margins of local portfolio banks, the rate's about 6.2 to 6.3.
Wow.
In that range. Agency, we're still finding a little better spread. So on agency loans, we're getting as low as 5.9. If we have a very high debt service at 155 and a 55% loan to value, if we have that combination with agency, we've gotten as low as 5.7, 5.6. So there's a couple of perks that we can use with agency. Number one, the debt service, if it's very low. And number two, if it's a low income demographic area, then we have another perk. So it can drive the rates as low as 5.5 potentially.
So it's a much different world, especially when you say 2 years ago we were in the 3s. Now we're talking about 6, and we didn't think we'd be here anytime soon. Looking back. But what I will say to that though is, if you go back to say 2006, the interest rate was about 6 and 6.25, and the market was flying high.
Sure.
So it's not necessarily that a higher rate will bring the market down. So what would you equate that to this time? In other words, so we had in 2006, market was flying high. The next sale was always a higher price per unit than the last sale. Buyers were optimistic. Everyone felt good.
Yeah.
Today, we've returned to about the same rate, and we're talking about half the business. Buyers are skeptical. How can you have the same rate in two different markets?
I didn't really prepare for that question, but I would have, based on my memory here, I would say 2006, our cap rates were probably 6.
Yeah, they were higher.
Right. So there were 6 or 6.5 cap rates. So it's always the discrepancy between cap rate and interest rate.
So I knew the answer. I was setting you up for it.
So the arbitrage is the key, right? And now that we have kind of an inverted arbitrage, so to speak, difficult to make deals happen. So,
but it's funny. So, deals were selling at 4% cap rates. That was like the expectation, and exclusive areas were selling sub 4%.
Sure.
And then to push to a 5% cap, in which you would have to change the price on a property.
Sure.
Sellers were like, oh, no way, no how, right? Because they got used to that's changed. I mean, that is how quick our memory fades. Because now a good portion of the buildings that are coming on the market today are 5 cap, 5.25, and because agents are telling sellers, hey, if you want to really sell the building, like, we have to offer a higher cap rate. Because why would you, as a buyer, to going back to to your comment on the arbitrage, why would you buy at a 5% cap, borrow money at a 6% cap? You're losing 1% on the money borrowed.
Sure.
Mr. Seller, you wouldn't do that deal. How can you expect the buyer? I know you think you got a great, sexy building, but nonetheless, we're all in this business to make money. Right. And especially today, when cities are lowering the hammer on rent control. We had just another city pass, Cudahy passed their own version of rent control. It probably won't be the last. The court, in the courthouses, is getting more difficult. The eviction process. So for the same reason you're selling, Mr. Seller, and you're asking a buyer to take on that yoke, well, there has to be some money to be made. We need to offer a higher cap rate, and that is the difference. So how can you have the same cap rate? Two completely different markets. 2006, things flying high. Today, things not so great, because in 2006, the cap rates were closer, said differently, closer to the interest rate. Today, that spread. If a seller looking to sell their building at a 5% cap rate, if the rate today is 6.25, that's a huge spread.
Right.
and impacts the cash flow
Right.
at the end of the day. Now, our next live educational event will be a few months from now. So there's plenty that can change. But say in the short term here, somebody's watching this video, they found this on YouTube, one of our current clients. They're one of those individuals that their loan is about to adjust. They've had a great rate. What are they looking at today? Let's say if you look at most of the major indexes,
Sure.
how much can their interest rate swing? Say if they locked in 3.5, what are they looking at today?
Yeah, typically on the first adjustment period, there's typically a 2% margin maximum. So if they're at 3.5, they're definitely going to 5.5. And the reason being is most of the short-term indexes are all in the 4s. And most of the margins that were written on certain loans were
That's a huge cut in
Right.
cash flow. That's
between 2.5 and 3.
Yeah.
Yeah.
Wow.
So fully indexed, they're really at 6.5, 7. Fully indexed.
So now let's expand that. And I was having this conversation with one of the commercial banks, and you have a huge segment of the market that their loans have either went adjustable or they're coming adjustable. They're seeing their cash flow change overnight.
You're right.
What do you think that means to the market, say, here in the next year to two, that they're going to experience that? If they refinance, they're going to lock in a new rate of, say, 6.25 or 6, or maybe 5.75. What do you think that means to the market?
Well, I mean, it's definitely softening. I mean, there's going to be folks that will deal with the refi, and maybe some of them will have to come out of pocket if they were leveraged.
So
It might not debt service.
Yeah, so let's touch there. So I didn't even think about that. So for the viewer, so in other words, they had a current loan and the appraisal and what have you, but simply because the interest rate went up, now the cash flow is different, the debt service so the lender may say, guess what, Mr. Owner, we'll refinance your loan, we'll cover your previous loan amount or however much loan amount, but you actually have to bring cash to the closing table. That's what that amounts to, right?
Potential. Yeah,
Wow.
depending on how much leverage was used previously. Yeah.
Wow.
Yeah.
So it's interesting. Where it sucks, for sure.
It's definitely something that I recommend for them to call me and let's get ahead of it. Let's be proactive. Let's look at that no rate. Let's see what is going to change. Let's see what your options are right now, because this is not a time to not be aggressively looking at your portfolio.
What about floating the rate? So let's say if they were at 3.5, it does adjust 2 points. They're now at 5.5.
Yeah.
You're saying potentially the rate could actually be, say, 6.25 if they lock. So you say, you know what, I'm going to float. Is that dangerous? What are your thoughts on that?
Well, that goes back to a chart, and that chart will be at the presentation. But right now, we've been floating between 4% on the treasuries, and we hit that in March. Then we dropped down to 3.2, and we went up again. Now we're 4 again. If we break that 4% on the treasuries, we're going to new highs on the rates. So I'm expecting, if we break, a 5% treasury. If we don't break, we could stay in that trading range between 3 and 4 for another couple of months. But eventually, we'll break higher.
And so let's even for me as the layman, in plain English, if the bank then wants, say, a 2-point spread, you're talking about rates in the 7s.
Absolutely. We already have some banks in the 7s now.
Wow.
Yeah. So we have some portfolio banks that are non-aggressive for whatever reason, and they're pricing in the 7s. But most of our lenders are in the 6s.
So if I'm an owner, my loan is about to go adjustable, or it is currently adjustable,
Yeah.
and I qualify, say, for an agency loan, and I can lock in, say, 5.75, something less than 6.
Right.
Although,
That's a windfall.
although it doesn't sound great,
Right.
it's a lot better than 7 if the treasuries can go on in that direction.
Exactly.
So we're in flux, and that's why we want to bring you this information. That's why I wanted Gil to step in with us today as part of this market update video. So you understand what's going on in the market. This is the reality. It's not what we wish it was. I wish it wasn't so. As I mentioned, across the board, sales are in half. Interesting times. Gil, thank you for
Chris.
hopping in here real quick with us.
Appreciate it.
And we look forward either to our next interview or when we have you at our educational event.
Sounds great. Thank you.
So what's the moral of the story? The moral of the story is if you would like to sell your multifamily property, values have changed. Cap rates have changed. If you're a buyer looking to purchase a multifamily property, understand the lending requirements have changed. Interest rates have changed. You need to underwrite your potential purchase very diligently to ensure that this is the cash flow that makes sense to you. All in all, the supporting factors of the market are there. Like I said before, buildings are full. Rental rates are still historically high. It's the lending world. And if potentially rates are going to go up from here, I don't think that means values will go up. As you've seen, the increase that we've had thus far has had a negative impact on the market, on values, on total sales. So if my belief would be then that if interest rates continue to climb and we get anywhere near 7%, as we learned with Gil, that would not be good for the market. So I'm not here to tell you one way or the other what you should do with your investments. I'm telling you, this is the reality of the market. It takes a strategy and a strict underwriting to understand what should you do next. There's still plenty of ways and strategies to earn money in multifamily property. Yes, the market is in flux, but even myself, I would buy a building today, even at the higher interest rates. I just refinanced a property at a higher interest rate because it made sense to do so. I'm in the process of selling a building that I own because even though I know prices are somewhat depressed, I see opportunity in a 1031 exchange. I'm still active. I'm still an active investor. There's still ways to make money. And if you're contemplating a 1031 exchange to sell your property, to buy something else, say potentially larger, or something that's going to bring you in more income, more tax savings, greater appreciation, remember, you're exchanging in the same market. So yes, prices may be down somewhat, but whatever you buy, the price is down somewhat. Many people feel like, well, now that the market has changed, maybe it's not a good idea for me to sell. What they're getting at is because they're not happy the value of their building has gone down. Well, if we could snap our fingers, take you back in time, and you could sell at a premium, guess what's going to happen on the other end of that scenario? You're going to purchase at a premium. No different than if you sell if you happen to catch the bottom of the market and sell at a lower price, well, guess what? Whatever you buy is going to be that much cheaper as well. There's always a strategy. Share your comments below. I'm curious, what are your strategies in the market today? What are you contemplating with your own investments? Or are there any additional questions that we could address? I also will mention here, we shared in our previous video all the rental rates for the various corridors that I service, that my team and I service. If you failed to watch that video, you didn't get a chance to watch the video, we're going to put a link here. And so that gives you, again, the rental rates for all the bedroom counts in the various corridors. It'll help you in your next vacancy. And if you like something that you can print, download so that you have this information going forward as you underwrite deals and you want to know what the market rents are in different locations, you simply can go to raisemyrents.com. Again, raisemyrents.com. Download our free report. We update the market rents quarter by quarter. That has the most recent data there for you. Now, do not forget to subscribe to our channel, turn on alerts. If you learned something today, please give our video a like. That's how we share this information with that many more landlords. And in the coming weeks, we'll be sharing that much more information with you, the information that's going to give you the strategies, insight, and resources to help you make your decision when it comes to your multifamily property. More importantly, that's going to help you in the building and sustaining of your financial legacy in multifamily properties. Chris German from The Apartment Dealer, and as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.